Hello and welcome to Trading Stocks as a Business. My name is John Plow. I got my start in finance as a commodities broker at one of the nation's largest retail commodities firms. Since that time, I have successfully traded in Forex, stocks, and the futures markets. This course is about taking the basic knowledge that you already have about the stock market and giving you a system that you can use applying the knowledge you already have in order to be a more successful trader. I'm going to show you exactly how and why I place trades, the kinds of stocks that I select, why I select them. I'm going to give you tools that you can use to select your own stocks and to apply this trading methodology. The methodology that I apply to the markets has been around for over 100 years. It's been employed by successful traders even before computers were available. When I first started trading stocks, I didn't have a computer. I used to get a chart book in the mail every week and I would flip through it. It was as big as a phone book, looking for the kinds of things that I'm going to show you how to find today using your computer. With today's technology, trading stocks is much easier than it ever was. In fact, the computer does the vast majority of the research for you. The market can still be risky. Trading stocks and commodities and Forex is a lot like playing golf in that your biggest enemy and the only person you're competing against is yourself. The market is going to do whatever the market does, but if you have a trading methodology that helps you profit from that, that's great, but it's up to you to follow it. One of the things I learned when I became a broker was that 90% of people who open up speculative trading accounts end up losing all of their money within the first couple of years. And there's a lot of reasons for this, and let's go over those reasons for failure before we talk about how to be a success. The number one reason that people lose money in the stock market is that they hold on to falling stocks. We're not going to do that. We're not going to delude ourselves into believing that we're long-term investors. That's not what we're here to do. What I'm going to show you how to do is how to pick stocks that are rising in value, how to stay in those stocks while they're rising in value, and how to get out if they start to fall. You should never hold on to a position that's causing you to lose money. That's mistake number one. Another mistake that many new investors make is they overtrade. They want to be in the market all of the time because they feel like they're going to miss out on an opportunity if they don't have their money constantly invested. Well, it turns out that you want to keep your money on the side until you've found an opportunity that makes sense to risk your capital. So if your money is constantly always invested, you're probably making a mistake. Most likely you're doing something wrong. Another challenge that many beginning traders face is that they want to trade off of tips. They're always looking for someone else to give them advice. I'm going to give you the tools where you will be able to go into the market, find stocks that fit a certain criteria, trade those stocks based on that criteria. You're no longer going to need to subscribe to newsletters or tip sheets or pay attention to the financial news network. In fact, all of those things will probably be detrimental in your trading. You're going to have to develop patience. One of the things that we do that makes us most successful in this market is we sit on our hands a lot. And when the opportunity is right, you place your trade and you let the market determine what's going to happen next. If you buy a stock and it goes up, well then great. We're going to move our sell order up behind the market at least once a week. And if the market falls down, our order gets triggered and the stock is sold automatically. If we get into a trade and it immediately moves against us, we're already going to have a stop loss in place. If the market hits it, the position is closed. Again, the market's going to make these decisions for us. We do not have to sit and watch the computer all day long. Place your trades, be patient. If you don't see a trade, stay in cash. Also, it would probably be beneficial for you to avoid any financial news networks. Don't read the financial papers. Don't watch anything on TV talking about the economy. Most of that stuff is smoke and mirrors anyway, and it's actually put out by Wall Street in order to create angst to get you to trade. You see, Wall Street makes money off of transactions. They need you constantly getting in and out in order to generate those commissions. Well, our game isn't to help pay commissions. Our game is to make money from Wall Street. Stay away from the financial news networks. Another challenge that many people have in the markets is they have a fundamental misunderstanding of how stock prices actually work. Well, we're going to cure that for you as part of this course. I'm going to show you the philosophy behind what makes these stock prices move. So as you're looking at the price fluctuations on a daily basis, you're not going to get suckered in by all of what makes a stock go down. When you look at a price chart, you're going to know exactly what phase of the stock's business cycle this particular stock is in, and then you'll have a clearer understanding of what to expect next. The final thing that you're going to get from this course that most traders do not have is I'm going to give you a workable trading system that you don't need a computer to have, but since computers are now ubiquitous, it will help you, but it's not necessary. With a workable trading system, this is going to allow you to let the market decide when you buy a stock and when you sell a stock. Your job is just to try and select the stocks that are in the right position to make the biggest move in the shortest amount of time. And I'm going to show you how to do that. Now, let's talk about a quick win. This course comes with some homework, and here's your homework assignment. There's 3 books that I need you to order and to actually read. The first book is called Remnants of a Stock Operator, and it's a fictionalized account of the life and trading activities of Jesse Livermore. Now, Jesse Livermore was probably the most successful individual stock trader that ever lived. He traded during the early 1900s, in the time period before computers, before chart services. He did basically what I'm going to show you to do in his head every single day of his trading life. The book takes you from the time he was a young boy all the way until he became relatively famous. It is a fictionalized account, but it is based on his adventures in the stock market. Another book that you need to get as part of your homework is How I Made $2 Million in the Stock Market by Nicholas Darvis. Now, Nicholas Darvis was not a professional trader. He was a professional dancer, but he traded stocks as a hobby. Nicholas Darvis recounts in this book how he made all of the mistakes that we talked about on the very first slide of this course. Trading too much, trading off of tips, not having a workable system. And then he turned the corner. And he tells you how he turned the corner. And in one bull market, he took his relatively small trading account and ran it all the way up to $2 million. The feat was so shocking that he actually became famous for that. He was asked to write a book about his experience, and he did, and the book is still in print. The third and final book that I would like you to get is called The Technical Analysis of Stock Trends by Edwards and McGee. This is a book that has been in print also for a number of years, probably more than 60. If you can, try and find an original hard copy of this book. The reprints do not render the charts in as good a quality as I would like you to have. So if you can find an original hard copy, go ahead and purchase that. If you can't find the original hard copy, one of the modern soft copy editions will do, but again, the hard copy is the best. Now, that's your homework assignment. You're going to get these 3 books. You're actually going to read these 3 books, because taking profits out of the stock market is a business, and you have to learn the business. And these 3 books are going to help you learn the business. The rest of this course, I'm going to focus on teaching you my trading style, how it works, why it works, and how you can apply it. The stock price cycle has 4 phases. The first one is the accumulation period. The second is a markup period. The third is a distribution period. And the fourth is a markdown period. Here we're looking at a price chart, and this chart shows all 4 phases of the market cycle. In the very front end of the chart, we have what is called accumulation. And what's going on there is that the Wall Street operators are purchasing as much inventory as they can possibly get a hold of in anticipation of selling it to a willing public. The next phase is the markup phase, here in the green box. During the markup phase, there's all kinds of excitement generated about a particular stock. That's when you'll hear lots of news stories about a great new invention, or whopping earnings surprises, or a new CEO. All kinds of energy is generated in order to get the buying public to take a look at the stock and then begin to bid the price up. The next phase is known as distribution. After the price is sufficiently marked up, lots of stock will then come into the market for those willing buyers to purchase. During the distribution phase, the market makers and Wall Street insiders are unloading what's left of the stock that they bought up during the accumulation phase. In many cases, depending on the security, they may also be initiating short positions. Once the distribution phase has fully taken place and there's no more reason to support the price of the stock, then we enter the markdown phase. And the markdown phase is the last part of the stock price business cycle. During the markdown phase, there's generally nothing but bad news that comes out about a company, or there's no news at all. You see, because stocks trade at an auction environment, if there's no excitement, there's no one there to bid the price up. So once the excitement stops, the prices naturally fall. And then the whole process starts over again. If you take any stock that has been around for more than a few years, you can see these phases rolling through over and over and over again. And what I want you to take away from this is that because stock prices move in phases, if you can identify which phase a particular stock happens to be in at the time you're looking at it, you're going to be able to have a pretty good idea of what is going to happen next with that particular security, because the phases always go in order. It's always accumulation, it's always markup, it's always distribution, it's always markdown. It doesn't matter what stock it is, they all go through these phases. Now, depending on the stock, some of them can stay in a single phase for years. That there's many things that determine that. However, they always go through these phases, and if you can identify which phase a stock is in, that's going to give you the power to know whether or not you should trade it, buy it, sell it, or just stay away from it. Currently, there's over 5,000 stocks that are actively traded in the United States. So there's a lot of opportunity. And all 5,000 of these companies are in one stage of this stock price cycle right now. Some of them are in accumulation, some are marking up, some are being distributed, and some are marking down. So there's plenty of opportunity every day. We use some technical charting indicators in order to help us determine which phase of the business cycle a stock is in. If you look at this chart here, you see this orange line. That orange line is called on balance volume. And what that is it's a study of the buying pressure of a particular stock. On balance volume is a formula that's been around for a long, long time. It was popularized by Joe Granville in his 1963 book, The New Key to Stock Market Profits. What we're looking at on the on balance volume chart is a running total of all of the share volume that is traded. When price goes up, the trading volume for that day is added to the total. When prices fall, the trading value from that day is subtracted from the total. And that gives us a running figure, plus or minus, which helps us determine whether more stock is being bought up or more stock is being sold. Unlike many other financial instruments, stocks have a recognizable supply and demand. Companies typically issue a set amount of stock, and that set amount of stock remains set for years usually, unless the company needs to raise money again. So because there's a set supply, a supply and demand curve actually really does apply in the stock market. If there's only 30 million shares available, then there's only 30 million shares you can buy at any price. And so as demand for a stock increases and the public buys the stock, puts it into their account, that stock is no longer available for sale. In most cases, your individual investors buy stocks and put them away. As they do that, the supply slowly constricts, creating more pressure. And what on balance volume helps us determine is whether or not there's buying pressure in a particular stock. Let's take a look at a chart. Okay, so on this chart, we're looking at a stock that is coming out of its markdown phase. The markdown phase is probably the easiest to identify. That's when prices are falling. If you see, there's almost no excitement down here on the volume plot. The volume is basically dead. And the reason the volume is dead is because there's no excitement. When there's no excitement, prices fall. And then we enter what appears to be an accumulation phase. Now, the accumulation is when interest in the stock is starting to come back. Now, if you look at the on-balance volume plot, you can see that for the most part on this chart, it's not really doing anything. And then when prices stop falling, the volume starts to pick up, and then the line changes direction almost before the price does. And so that gives us an indication that this stock has moved from the markdown phase into the accumulation phase. And when a stock enters the accumulation phase, that's when we get interested. Now let's talk about another indicator that we use. A Daunton channel is a line that's plotted on your chart that shows you both the highest high values and the lowest low values for any given period of time. Now we're going to look at an example of this here in a minute on an actual price chart. The purpose of plotting the highest high values and the lowest low values is that it gives us an immediate visual reference to how volatile a particular stock is. This gives us a place to know where we can place our buy orders, where we should place our stop loss orders, and it also gives us a visual reference as to when trend has changed. Now, the length of time that you set your Daunton channel to really depends on the kind of trading system that you're implying. How long of a trend are you looking for? How much risk are you willing to take that you might get suckered in with a sucker rally and whipsaw? I commonly use 8-day and 13-day Daunton channels to determine my stop losses, and then 21, 34, and 55-day channels to determine when is a good time to purchase a stock, looking for breakouts. Let's take a look at another chart. Okay, so now this is the same chart we looked at before, and again we have our on-balance volume line plotted, and as you can see, as this stock enters what I believe is accumulation, the on-balance volume picks up, the trading volume picks up, and the Daunton channel gets a really long floor in it. Now the reason it has a longer floor is because this particular stock during this time period has not made a new low. And that's significant because if you're coming out of the markdown phase, you can see that the markdown phase constantly has lower lows and lower highs. We can tell that maybe something is about to change because the lower lows have stopped, and all of a sudden we enter into an area where we have higher highs. And that's significant. It's easy to spot on the chart. Once you know what you're looking for, it just leaps off the page at you. Now let's talk about the characteristics of the accumulation phase, because that's the key phase that we want to be able to identify before we place a stock trade. You probably want to write this down because this is the beginning phase of the stock market business cycle, and it's the most important phase for trading the system that I'm going to show you. Accumulation first is characterized by little or no price rise. Now that's interesting, and here's why that's interesting. During the accumulation phase, the market manipulators are trying to buy as much stock as they possibly can before they move the stock into the markup phase. So they have to take little bites at a time. This is done with a little bit of volume because they don't want the public to know what's going on, because if the public gets involved, they buy the price up before the manipulators are able to accumulate their large position, and that's not what they want. So typically, when a stock is under accumulation, there's going to be very little rise in price. There's going to be low average trading volume. The price is going to have a very definable low and high. And the reason for that is they want to keep the volatility down so the price of the accumulated stock is stable. Another thing that you will typically see on the better accumulation patterns is long, wide smiles. And I'm going to show you exactly what that looks like on the chart. But remember, we buy smiles and we sell frowns. Furthermore, during the accumulation phase, you're typically going to see a gradual rise in the on balance volume line. So when you see all of these things together in a single security, that tells you that that particular stock is in the accumulation phase and that its next phase is gonna be the markup phase unless something changes in the underlying market conditions. So we're looking for little or no rise in price, low average volume, occasional volume spikes, clearly definable low and high periods, a long wide smile or a series of small smiles, and a gradual rise in on balance volume. When you see those things all on the same security, that's when your interest should be piqued, and that's when you should be ready to place a trade. This is a stock that I actually did trade based on spotting the accumulation phase. This is a screenshot of my actual trading account. This is the chart that I used to trade it with, and as you can see here, I entered this particular trade in November, and when the screenshot was taken, I was still in this trade and was profitable by about $3,700. I can tell you that as of the recording today, I am no longer in this position. I actually closed it out. Now, let's talk about what accumulation looks like. We mentioned on the other slide some characteristics that you want to see on a stock pattern when you're looking for accumulation. And so on this particular chart, we have rising on balance volume all the way through the whole chart. That means there's some pretty aggressive buying going on. There's almost no dips all the way through this. During this period here, for about 3 months, you can see that the stock is trading in a tight, highly definable low and high period. Exactly what we're supposed to be looking for. In addition, the relative volume, those are these bars down here, is low. There's not a lot of excitement being generated about this stock, but it's still being bought. There are also occasional volume spikes. Again, this is exactly what we're looking for on a stock that we believe is about to enter the markup phase. Now, if we get into August, we see there's a huge spike in trading volume in August, followed by a rally in prices. And then prices fell back into another accumulation period. Now, it's possible that you could have been watching this stock, placed a trade into this breakout, traded it all the way up, and then were stopped out, and then the price fell back into this accumulation period, and you can trade the same security again. It's not against the rules. We trade in and out of the same stock. Now, I didn't trade this particular peak. When we move through September, October, and November on this particular security, let's take a look again at what happens with the characteristics of this stock. Volume again becomes quiet with occasional spikes. The on-balance volume line, which peaked back here, slowly sloped down, and then in September, again, it started creeping back up. This is exactly what we're looking for. Finally, we have this long smile in prices. Also, there's a smile with the volume. This chart is being friendly. It's smiling. It's saying, please, come by me. All through this area here, I am identifying this as the accumulation phase. This breakout area is the beginning of the markup phase. And then this run through here is the markup phase. And this violent price churning at the top is possibly distribution. Now, we place orders to follow the market up. So if prices start to move against us, our position is closed out, whether it's a profit or a loss. In this particular trade, it was closed out in this general area. I don't remember the exact price, and this was a profitable trade for me. I bought on the breakout of the price here, rode it all the way up for this 2.5 months, slowly moving my stop loss up behind the market. Let's take a look at a different stock and a different chart. Okay, this is a completely different company, and what I want you to look at on this chart is, again, you can see a couple of different phases of the stock price cycle taking place over a period of a couple of years. Right up in here on this peak is a distribution area, and the distribution area is always followed by a markdown. As you see, prices went down for almost 2 years on this particular security. That's a long markdown area. Now, if you're inclined to sell short, once you identify a distribution area, we trade them almost exactly the same way as we trade the accumulation pattern. You place an order when the price breaks out. In this case, it breaks to the downside. You sell the stock short. As the price falls, you move your sell order down behind the falling price. And when the trend finally stops moving or reverses, or you get stopped out, that's it. You're done trading, and then you look for another opportunity. But by identifying the different phases that a stock goes through, you can identify what is most likely to happen next in that price's chart pattern. So here we're looking at a 5-year daily chart of this particular stock price. We see distribution, we see markdown, and we see down here in this little oval what looks to me like a fresh accumulation period. Now, this is that same chart, but it's zoomed in. Instead of looking at 5 years of price history, we're looking at 2 years of price history. And if we look at this chart, again, I have this oval here so you can see what I believe was accumulation. During this accumulation period, it lasted almost a full year. So that's a pretty long time period for a stock to be slowly getting accumulated. And as you can see, this is a chart that was taken live from my account. I did trade this stock at the time of this recording. I'm still in it. I'm not recommending you trade it. I'm just telling you that I have traded it. And as of this recording, I'm still in it. Let's take a look at the chart again. Now we've zoomed in even closer. Instead of looking at 2 years trading activity, we're looking at about 1.5 years here. As you can see again, we have the price is trading in a pretty discernible price pattern here. The low for this area has been about 40 cents. The high has been about 80 cents. Now, on a stock that cheap, it has a 100% trading range, but we're only talking about pennies here, so let's not get too excited. The point is, when you look at the chart, you can clearly see that when it gets to about the 80 range, it stops going up. And when it gets to about the 40 range, it stops going down. It's clearly definable. It just leaps out at you right off the chart. You don't need any of the drawings. You don't need any special extra indicators. You can just see what's going on. Now we're going to add another word to our vocabulary, and that word is base. Now, a base is an area of price movement where there's a little bit of consolidation after an initial move. A base is almost always the first stage of the markup cycle in a stock. When I see a stock that I already believe is in accumulation, that then peaks and bases, that's a trade that I'm going to take if I have enough risk capital available to take it. If I'm looking at 3 or 4 different charts, and I see an accumulation phase followed by a base, and of those 3 or 4 charts, there's only one that has the base, I trade the base. What is a base? It's another well-defined period of high and low prices. We're going to look at some on some charts, and they're just going to leap off the page when you see them. The on-balance volume has already spiked once, but it will tend to drift sideways and sometimes even slightly down during a basing period. Initial bases are frequently followed by a shakeout, and I'm going to show you on a chart what a shakeout is, but a shakeout is a manipulation by the market makers and the people who control the price of stocks designed to shake small holders out so they can accumulate more stock before they run the price up. Now, I have been shaken out of stocks before, and it can be frustrating. But when I see a shakeout followed by a base, I get excited because that is almost always going to be one of the best trades you can possibly take. Because traders tend to place their stop loss orders close to bases, bases are frequently subject to stop runs and shakeouts. Let's take a look at a chart. Okay, so now we're looking at that same chart that we looked at before, except this time I have a little oval highlight around the base. So here we have this clearly definable period of price activity. that I believe is accumulation. Then we have this little dip, which I believe was a shakeout, followed by a quick rise in prices, and then another consolidation period. And what's interesting about this period here that I'm saying is a base is because it followed this shakeout, I was so enthusiastic about this stock, I went ahead and bought it in the base rather than wait for the breakout. Typically, we like to buy stocks as the price is moving higher. We place stop orders that will only be activated as price moves up through them. Most of the time, that's how I trade. But when I see several years of accumulation followed by a shakeout, followed by another base, with a couple of smiles in here, and we're going to look at the smiles, but see how that chart is just grinning at you? It's saying, please come buy me. There's another little shakeout here with a little bit of smile, and then another consolidation area. There's actually a base inside of this base. This chart is screaming buy me. So, as you can tell, I did. I bought 2,000 shares right in here at 65 cents a share. When this chart was actually copied to prepare these slides, the price of this stock was sitting at $2.49. As of this recording, I'm still in this stock. I'm not recommending you buy it. Opportunities like this come around every day. There's no reason to chase a price. In fact, chasing a markup move is probably the wrong thing to do. You want to catch the markup move in the first 10 or 15% of the move. Okay, now again, we're looking at the same chart. I'm using this chart because it is such a classic example of exactly what we're looking for in this course, that I want to burn it into your mind that when you see all of these things moving together, that's when you have the best opportunity to have a massive explosion in price. This orange line here represents the area where many traders will place their stop losses. Now, I didn't buy this stock during this time period of accumulation. I was waiting to see if there would be a rise. However, many people did. And as you'll see inside of this little circle here, just before the market manipulators took this stock up, they wanted to make sure that they could accumulate as much stock as possible. So in order to do that, they sold into a weak market, pushing prices down, which then activated all of the stop losses that would be sitting on that orange line. Those stop losses create selling activity, which brings lots of stock into the market that otherwise would not be there. The market manipulator then buys up all of those extra shares of stock, and the buying activity at that point, if it is a real shakeout, prices typically only go down for a couple of days and then immediately reverse. The whole point of a shakeout is not to crush the market, but just to get as much stock as before you go back into the accumulation phase, preceding the final breakout into the markup phase. And that's exactly what happened here. Now, if I was in this stock, I would have had my stop loss order placed probably somewhere around that orange line, which means I would have got caught in the shakeout period. So I probably would have lost $400 or $500 depending on how much money I had in it. I normally risk anywhere from $500 to $1,000 per trade. There's plenty of trading activity, and I prefer to take smaller bites rather than larger bites. But in your account, you can do what you want. If you don't want to have 50 open positions at any one time, trade $10,000 per bite. Depends on how big your account is. Anyway, this shakeout period would have stopped me out. And I would not have been upset. In fact, I would have been excited, because when I see a shakeout followed by accumulation, that tells me the move is going to be good. And I probably would have bought back into the stock after it made a new high. But I didn't buy down there. I bought up here, so I didn't get caught in the shakeout. Okay, now we talked about buying smiles, and so I just wanted to throw some smiles on this particular chart so you can see what they look like. Many times, smiles and frowns will show up both in the price activity and the volume activity, as you see here. I threw up a little frown right there. There's a frown. And what did the price do? It dropped. There's a frown and a frown, followed by falling prices. We sell frowns and we buy smiles. Okay, now let's talk about the markup stage. Now, the markup stage is the easiest stage to identify of all of the stages. Now, the challenge with the markup stage is that you want to catch the markup stage in its early breakout, or you want to catch it in the middle from a base. We always want to trade from an accumulation period or a base. And the reason we do that is that it just turns out that when you catch a stock as it comes out of a base or an accumulation period, it has a tendency to move far enough to make the trade more likely to be profitable. So your markup phase is going to be characterized by rising price, rising on balance volume, lots of good news, new product, new CEO, new profits, new invention, whatever. If you're in the markup phase, there's going to be news, because news is what gets the public to buy stocks. Now, a stock in a markup period is typically going to make a new price high several times a month, usually weekly. Markup periods tend to have waves. There will be 3 to 5 pushes up on a markup period that has followed a base for 6 months to a year. This has been my experience. It's been this way for 100 years or more in the stock market. It just happens to be the way it is. Now, if you're in a stock and you're in the markup phase and the price is going up and you're following the system that you're learning here today, you're going to be placing your sell orders behind the rising price as it goes up. We do not wait and count waves to decide when we're going to sell a stock. If we're in a stock and the price is rising, we're moving our sell order up behind that price in a systematic and mechanical way, because the market itself is going to determine when we sell that stock. And we will sell that stock regardless of what wave it's in or how long it's been in the markup period when the price moves against our position. Let's take a look at another chart that has an accumulation, a base, and a markup. Okay, this is a chart that I did trade, and I'm going to tell you right now, I traded it wrong. Now that you know that, I'm still profitable in this trade as of today. So one of the interesting things about being in a raging bull market is that a rising tide has a tendency to lift all boats. So if you're in a bull market, there's a lot of public excitement and a lot of buying pressure. So you don't have to be a genius to make money trading stocks in a bull market. Where the genius comes in is knowing which stocks are the best stocks to buy in any given bull market to give you the highest chance of being able to make phenomenal returns. Let's go back to the chart. Here we have a markup period. This appears actually to be distribution to me. I would not use this period, this particular chart, as an example of accumulation. And what's interesting about that is that subsequently, this chart jumped from a distribution period back into an accumulation period, and it did it on high volume. One of the keys we look for on a chart is a volume spike. We're going to cover that in more detail, but when you see a volume spike, that is an indication that a stock is getting ready to change phases. This particular stock went through a markup period, went into distribution, went back into accumulation, created a base, and went into a markup period, and each one of these phases in price movement was marked by spikes on the price. Here's your distribution beginning, here's your accumulation beginning, there's your breakout into forming the base, and here's the beginning of the markup. Look at all of that volume coming in there. That volume is public excitement. When you see volume like that, that tells you that lots of people are saying, I want to own this stock. You want to buy the stock as soon as it wakes up. When this stock wakes up and starts moving up, the higher it goes and the more volume that comes into it, the more excitement is being created and the more people are coming in and bidding that price up. That's why these kinds of patterns that I'm showing you result in these kinds of phenomenal price moves. If it's gonna move, they have a tendency to explode because the excitement that's created by the volume drives it higher. Remember, the stock market, even though it's inside the computer now, is still an auction. and auctions drive prices up. Okay, this I believe is distribution. I don't know what happened with this stock that made it flip from distribution to accumulation, and I don't care. I don't know what this company does. I don't even know if they make any money. None of that's relevant. What we're doing here is we're making money based off of the phases that businesses go through with their stocks. And if you can identify the phase, then you can trade the next phase, and that's how you're going to be profitable. So here's the volume spike. Now we go into accumulation. Look at what happened with the on-balance volume line. It's gradually falling through here. Then you get the spike in price, boom, followed by the spike in volume, and then the on-balance volume line moves sideways, up, and then sideways, and then way up. If on-balance volume is moving sideways, that's neither good nor bad. It's better if it's moving up. If it's moving down, that's probably a characteristic of distribution. We also have something else on this chart which makes this such an exciting chart to catch before the markup stage. We have a smile in the volume and we have a smile in the price. And when a stock smiles at you with both volume and price, it's saying, please come buy me. Now, we have another huge spike in volume. You would have been justified in purchasing this stock right here. In fact, that's what causes the spike in volume. People buying the stock. But you would also be justified in buying it right here. You're more justified here than you are here. Why? Because first we want an accumulation phase, then we want a basing period. When you get an accumulation phase followed by a high volume breakout, followed by a basing period, what you're seeing happen is a buildup of momentum. Now, the only other thing you need to see is for the public to jump on the stock like crazy. And that's why you put your orders to buy as price moves up. There's no reason to sit in a stock if it's not going to go up. We're not dividend investors. We're auction buyers, and we're going to buy that markup phase when it begins. Well, as you can tell, this is a screenshot out of my actual trading account, and I bought this stock late. I'm not telling you to buy stocks in the middle of the markup phase. This is a mistake. But because there's so much energy and excitement created by these volume spikes and by this long accumulation period, on this particular chart, it didn't matter. I bought in at 230. When I took this picture, the price was 458. So there's a 100% move in about 3 or 4 weeks. That's what the accumulation phase and the heavy volume spikes creates. It creates the energy to make those kind of moves. Now, let's talk about the distribution phase, because the distribution phase is something that you really need to be able to recognize. In fact, being able to recognize distribution is more important than being able to recognize accumulation. Now, why is that? Accumulation and distribution look similar on a chart. The difference is distribution is there to pull in suckers to buy stocks that are about to fall. And I don't want you to be a sucker. Let's talk about what distribution looks like. During the distribution phase of the stock life cycle, there's going to be increased volatility. Now, volatility is the percentage difference between the low trading price of the day and the high trading price of the day. That swing in prices is volatility. Now, some stocks are more volatile than others, so volatility is always relative to the stock's own market actions. If a quiet stock suddenly becomes loud, that's an increase in volatility. If a loud stock remains loud, that's basically the same. Nothing's changed. If a loud stock goes quiet, that's a decrease in volatility. If a loud stock gets louder, that's an increase in volatility. So it's all relative. When you see it on the chart, it stands out. It's going to scream at you that something has changed in the character of the trading of this security. So, volatility. On-balance volume begins to move lower. At the very least, it's not going to make many more new highs. Price may still move higher, but the price action itself is going to look different, and it's going to fail when it makes a new high. It will spike up, stay a day, fall back down. There's no follow-through during the distribution phase. Eventually, what's going to happen is that successive lows are going to take over. So price is going up, going up, going up, dips, there's a low. then it goes up a little bit more, gets kind of volatile, makes a lower low. That's characteristic of the distribution phase. During this stage, what's actually going on is the Wall Street manipulators who control the prices of these stocks are finally unloading all of their inventory, and they're going short. And so they need to maintain an excitement level for the general public to continue buying stock that they're selling to them short with the anticipation of the coming markdown phase. Once the market manipulators have distributed all of their long stock and sold short as much as they care to carry, they will cease to support the price of the stock. And then the bad news comes. The CEO retires. Oh, this quarter wasn't as profitable as they thought. The new product kills people. Doesn't matter what it is, but the bad news is going to come. At that point, the general public becomes fearful, and they no longer bid the stock up. And because stocks trade in an auction environment, if no one's bidding to buy it, the prices will slowly fall. Let's take a look at another chart. So here we have a smile, we have a markup phase, and then we have this violent churning of prices that just looks different than the rest of the price activity. And the reason it looks different is because it's a different phase. Where the stock is quiet and moving sideways with rising on balance volume, that's an accumulation phase. While the price is steadily rising, that's a markup phase. When the price becomes volatile and doesn't make any more new highs, that's the distribution phase. Now, I didn't trade this particular stock, but had you traded it, if you were using the system that I teach, you would have bought it somewhere in this general area. As the stock went up, you would have placed your sell orders behind the rise in price. Boom, boom, boom. Which means, had you been doing what you're supposed to do based on the trading system I'm teaching you, on this huge day right here, your position would have been closed out. Now, depending on where you got in, you would have been closed out at a profit or a loss. If you would have bought this markup phase late, you probably would have lost money. If you would have traded it the way I tell you to trade it, which is to catch it as it moves out of the accumulation phase into a base or the markup phase, then you probably would have done okay. But the point is, when the stock moves into distribution, you're going to be able to see it. On balance volume stops going up, price action changes. This stock is just screaming that market conditions have changed. Okay, let's talk about the markdown phase. Now, if you're inclined to short stocks, I don't do much stock shorting myself. I don't think the odds are with you as a stock shorter unless you're a market maker. But if you can identify properly the phases that a stock is in its price cycle, you can sell short just like you can buy long as you get the phase right, and you're going to have a pretty good chance of being profitable on the trade. So what does a markdown phase look like? There's a similarity between distribution and accumulation, and the similarity is during both distribution phases and accumulation phases, the market makers are rotating their positions and they are accumulating a new position in anticipation of the next phase. During distribution, they're loading up on shorts. Stock prices will tend to fall faster than they rise. In a rising market, there's lots of price support, there's lots of excitement, but there's also market makers selling into that price rise. That's the whole point of the markup phase. This creates a nice solid floor for prices that you can move your sell orders up. That's why the system works. The markdown phase, Wall Street has no incentive at all to support the price of a stock. In fact, the faster it falls, the happier they are. Because there's no incentive to support the price of the stock, the price movements tend to be more violent and they tend to be bigger. And then, once the public is totally discouraged and there's no more selling pressure in the stock becomes boring. Then the markdown phase really begins as the price gradually falls every day because there's no buyers and the market makers are short and they don't really care Let's look at a chart. Now, this is that same stock that we looked at before when we identified at the beginning of the distribution phase. Now, this whole time period right here is distribution. This whole time period. And this distribution phase went on 1, 2, 3, 4, almost 5 months of a distribution phase preparing for the markdown phase. Now, on this particular chart, we see that there was a spike in on-balance volume at the end of June. But what happened was called a failed auction. Here's the original high where distribution began. Then you have this huge spike in volume, but the price was not able to make a new high for that security. And what that tells you is that even though there was a volume spike and on-balance volume went up, because this was a failed auction, we're highly likely to enter the markdown phase next. So many traders would take a look at the two lows and draw a line that's called a support line, and then they would sell a break below that line. And that would be the right thing to do if you believe that a stock is in distribution and prices are moving lower. So if you were trading this based on the methodology that I teach, you probably would have went short somewhere in this general area. We're looking again at a chart of the same security during a different time period. Up here in this corner, that's the area that we already identified as being distribution. This is the line where most people would trade it short, and this is the subsequent markdown period. But also this period here could be called distribution as well. Sometimes you will move from one distribution period into another distribution period, just like you can move from an accumulation period to a higher accumulation period before the real markup happens. But a key thing that you can see on this particular chart is the reverse of a shakeout. This is called a sucker rally. And what a sucker rally does is the same thing that a shakeout does. They will run the price up to activate all of those buy orders to accumulate as much short stock as possible before the distribution phase ends and the markdown phase begins. Now, what happens if you get caught in a sucker's rally? Well, you're always going to trade with a stop loss. So if you're watching this distribution period and you believe that it's actually accumulation, so you place your order to get in and the prices move up and you get in and then you get suckered and the prices begin to fall, don't worry about it. Get out of the stock. That's why we place stop loss orders. And then ask yourself, I thought this was going up, but actually it's going down. Does that mean that that period that I thought was accumulation was actually distribution? If you're looking at a distribution phase on a stock, what's the next phase? Markdown. So if prices are already falling, you're in the markdowns phase. Maybe you have an opportunity to reverse your position, go short, get in sync with the phases of prices, and trade the same stock short and make back what you lost on the long side. That's a decision you get to make. I don't typically trade short that often, so it's just not really something I do a lot of. But had you've done it, this particular stock went from $8 a share right after the suckers rally, to 38 cents. That's a pretty good move. You probably wouldn't have stayed in for the whole move because there was another head fake here, which looks a little bit like accumulation, followed by a sucker rally from $1 to $2, and then whatever trauma took place here, but to actually finally kill the stock. And as you can look, stocks die the same way they're born, with lots of excitement. In fact, there's actually usually more excitement when a stock dies. Look at how heavy that volume is compared to over here, compared to the rest of it. That's everybody running for the doors. Okay, so let's summarize this section so we can understand what we've just learned. All stocks trade in phases of price movement. And if you can identify those phases, then you have a pretty good idea of what phase is going to come next, because they always come next. It's a cycle. The first phase is accumulation. The second phase is markup. The third phase is distribution. The fourth phase is markdown. They always follow that order. Always. We also talked about some things that you can see on a chart that will give you an indication that the current accumulation phase or distribution phase is going to be more powerful and a great move, and to help you determine which stocks are the best stocks to buy at any one point or to sell. In chart patterns, we always want to read the volume. Always read the volume with the price. The two things work together. Remember, stocks trade in an auction environment, and auctions are based on excitement. Plot the on-balance volume line on your charts. That's going to help you determine what's most likely to happen next. Remember, during the accumulation phase, on-balance volume likes to rise. During the distribution phase, it likes to fall. Look for bases. And the base is a period where you have a shoot up in prices followed by another little period of quiet activity. Bases also occur midlife in the markup phase. Because they occur midlife occasionally in the markup phase, and there's usually 3 to 5 of them, they give you another opportunity to place a trade in a stock where maybe you missed it to begin with, where if there's a new fresh high coming out of that base, you can buy it. You have a nice anchor point for your stop loss, and you can catch it again. We look for smiles and frowns. And when we see a smile and it's in an accumulation period, that's a stock we get excited about. We buy smiles. We sell frowns. If you get shaken out of a stock, and a shakeout is a dip that clears out the stops and prices, followed by, usually within a week, a new high, that's a stock to get excited about. If you see a shakeout followed by a base, that's one of the most powerful moves you can have if everything else is there. Let's talk about some things that you just need to understand to help you be more successful in your trading. There's a difference between price and value. Price is what you have to pay for something. Value is what that something is actually worth. What the stock market attempts to do is to bring the price and value of stocks into alignment. But I don't think it does it very well, and I don't even care, because we are not buying stocks to keep. We're not marrying any of these securities. We only date them. We buy stocks when the public perception of value is higher than the price. And what that looks like on a chart is a markup period. That's it. That's what we're doing. When public perception is that the stock is worth more than it's currently trading for, they bid the price up. We wait for the public to get excited about a stock, and then we buy it during the initial excitement phase. And we ride their excitement up, and we don't care anything about the value because we're not going to keep it anyway. We're just there to participate in the excitement. And when the excitement ends, or when the public gets jaded, or when the move is over and the price begins to fall, we get out because we trail our stop losses up behind the market. Stocks trade based on a perception of their future value. And if you watch the financial newspapers, or you watch CNBC, or you read any books about investing, they all talk about earnings growth, balance sheets, dividends, how good the management is. Those are all things that are indicative of a perception of future value. And in order for a stock to rise in price, there has to be a lot of public perception of future value. The general public believes stock value is determined by current earnings, future earnings growth potential, and dividends. Okay, I'm not going to argue with them. Wall Street manipulates these beliefs to create demand in the buying public to purchase these stocks. Now, I'm going to give you my controversial opinion. You can take it or leave it. My personal belief is that most of this stuff is phony. The only share of stock, in my belief, that is worth owning for the long term is a company that is rising in price and paying a dividend. If you're thinking you're buying stocks because the chairman of the board feels for the shareholders, you probably have a misperception, because the vast majority of stocks trading in the United States do not pay a dividend. And if the stock does not pay a dividend, you are not participating in ownership of that company. That's the bottom line. The vast majority of stocks are managed for the benefit of the board of directors and the CEO, and that's about it. So we buy stocks that rise in price. We sell stocks when they stop rising, and we stay in cash when it's a bear market or if we can't find a suitable trade. Why? Cash is your opportunity, stock is risk. The actual value of a stock is what the price is at the moment that someone is willing to buy it for you. All of this stuff about future value and potential earnings is all smoke and mirrors. At any one point in time, that stock is worth what you can sell it to somebody else for. And don't ever forget that, because a stock that's falling in value and moving against your position may be worthless the very next day. I can remember a very famous market commentator who said on TV, "I would be a buyer of Bear Stearns today." This guy claims to have 20 years of trading experience, big hedge fund manager, and he tells the general public to buy a company that everyone with any common sense knows is going to be bankrupt by Monday. Oh, I would buy it today. There's no such thing as future value on these stocks. They are worth what someone's willing to pay for them at the moment. What we look for is indications that the public believes prices are going to go up. And when the public gives us that information, then we buy the stock and we write it up. To be a successful stock speculator, you must confine your activities to stocks whose prices are most likely to be affected by public excitement and auction euphoria. How do you determine that? How do you know when the public is excited about a stock? Well, you get a spike in trading volume. You don't have to watch CNBC, you don't have to read the newspaper, you just have to have access to price and volume charts, which your broker's going to give you for free. Volume spikes show how public excitement is growing, and it creates more excitement as people who track volume go, wow, look at that stock, all of a sudden people are buying it. That's excitement. That's how auctions work. Excited auctions sell things for lots of money. So the first criteria that we're going to use, and you should write this down, is we look for stocks with a massive increase in relative volume. Stocks that are under accumulation look like they're asleep. We want to buy the stocks when they wake up. And you can tell when they wake up, because when they wake up, the volume spikes. So you're looking at a stock and it's dead asleep. It's moving sideways. There's very low volume. On balance volume is slowly creeping up. But you don't want to put your money in that stock yet. Why? Because when you own a stock, you own risk. When you own cash, you own opportunity. And we want to keep our opportunities maximized and our risks minimized, so we don't sit in stocks that are asleep. How do you know when the alarm clock has gone off? Well, the alarm clock of a sleeping stock is a trading spike that is 3 times the average trading volume for the previous year. So when you see a stock that trades, 10,000 shares a day, all of a sudden trades 100,000 shares a day, that's the alarm clock. That stock just woke up. Heavy trading volume is the first thing that we look for when we're seeking a new trading opportunity. You're going to set up a search criteria in your broker that is going to look for that spike in trading activity. Now, I will show you how I have done it with my broker, but each broker's software is a little bit different. So you're going to have to learn how your software does it. Now, interestingly enough, almost every stock trading company has a built-in screener that will tell you what the most active stocks of that day is. And the reason for that is they want you to trade. So they want to create excitement. Therefore, they want to pull you into where the excitement is, so you trade. But remember, we're not looking for the most active stock of the day. We're looking for a stock that used to be asleep, that the alarm clock went off on, that is suddenly about to move. And that has to do with relative volume to the stock itself, not to the whole market. So we want to set up a scanner inside your technical trading platform that is looking for at least a 3 times spike against the average trading volume of that stock. The volume spike list. The purpose of this volume spike list is to show you which stocks you should be concentrating your efforts on. If you don't have the technical ability to go into your stock trading platform and set this up, begin by using the most active trading stocks list. Now, that's going to give you a lot of stocks to look at, but you're going to use them by looking at the charts. And I'm going to show you how to set up your chart. So if you have 50 stocks to look at every day that are on the most active list, you're going to be able to bang through that really quickly and see if there's anything there that fits this criteria. And then I want you to call the technical experts who design the software for your particular brokerage and ask them how to set up a screener that will show you when a stock has boosted 3 times its average annual trading volume in one day. And they'll tell you how to do it because they want you to trade. Now later on I'm going to show you how I've done it with my broker, and if you use my broker, great, you'll be able to do it. The purpose of looking for the volume spike is to give you stocks that you can concentrate your efforts on. There's 5,000 different securities trading at every given point in the stock market. The vast majority of them are not worth looking at. There's no point in wasting your time looking at a bunch of dead stocks with no public interest that are likely going to fall in price anyway. We want to concentrate on the sleeping giants that have just woke up. We trade stocks other people want to buy. Now let's talk about setting up your chart screen. We want to use a daily price chart. I also occasionally will look at weekly price charts, but most of the action that we're going to be able to trade is going to take place on the daily chart. You want to set your chart scale so you can see about a year of price activity, anywhere from 9 months to a year and a half. Depends on the charting program you use, but that's where you want to scale it. On the price side of your chart, you want to make sure that you're looking at a logarithmic or a semi-logarithmic price scale. Well, what does that mean? Prices move based on percentages and not based on the actual dollar value. So, a stock that moves from $1 to $2, that's a $1 move, but it's also a 100% gain. You've just doubled your money. Now, if that same stock moves from $2 to $3, that's not a 100% move. It's still $1, but it's not the same percentage move. So the money is not the same. If that same stock moves from $3 to $4, it's moved $1, but it has not moved 100%. That's more like a 25% move. And so the higher a stock moves, the more dollars that same stock has to fluctuate to give you the same percentage return. And so in order to make the percentage return appear consistent on your chart, you have to use a logarithmic scale, because a logarithmic scale is graduated based on the percentage return. Now, all charting programs that I've ever used give you the option of using arithmetic or logarithmic scaling. Make sure you have yours set for the logarithmic scale, because we're here to trade for big percentage moves, not to pike around for $1 at a time. Now, in addition to that, you want to make sure that the trading volume plot is on every chart you look at. Those are the lines, boom, 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 underneath. That's going to give you an idea of the relative excitement behind a particular stock's move. You have to trade price and volume together if you want to be successful. On your volume plot, I want you to add a 200-day moving average of the volume. This is going to give you a line that cuts across the volume, and it's going to give you a firm visual of when a volume spike has happened, when trading activity is unusual. If you don't know how to do that, contact your broker's technical people and tell them, here's what I need help with. I want to put the volume on the bottom of my chart, but I want to put a moving average of the volume, overlaying it so I can see at a glance what the annual average daily trading volume is. They'll know how to do it. It's available on all charting platforms, but because this is a technical question that is specific to your particular charting platform, I can't tell you how to do it. I'm going to show you how I do it with the company I use, but whatever broker you're using is going to have this ability that's just built into the program. Someone will be able to show you. In addition to that, I want you to add the on-balance volume indicator or the price volume trend indicator or both. Now, some charting platforms use on-balance volume. Some charting platforms use price balance trend. They are basically the same thing. They're calculated a little bit differently. It doesn't matter which one you use. They're going to give you the same information. And if you can use both, that's even better. In addition to that, we're going to plot what's called a Daunton channel or a price channel overlaid the price of our security of at least 21 days. And the purpose of that is it's going to show us the highest high price and the lowest low price that that security has traded in for the last month and 1 day of trading activity. And I'm going to show you on a chart what all of this looks. And later on, I'm going to show you in my trading account how this looks when we go through and put all of this together as I show you what markets I'm trading as of this recording. You need to write this down. This is the meat and potatoes of what we're going to do. This is the trading criteria. Now, we talked before that the public perception is that stocks are more valuable when they have the potential for earnings growth. If you watch anything or read any books about investing, they all say this. Earnings growth, earnings growth, earnings growth. So because the general public believes that, I want that to be your first criteria when you select a stock. It doesn't matter if the company is losing money or making money. What matters is that the earnings are going up. Why? Because that's what the public wants to see. So your stronger stocks that are going to be able to generate more excitement is going to be the company who was losing 50 cents a share last quarter, but this quarter they're only losing 25 cents a share. Now they're probably on their way to bankruptcy, but the general public perceives that a company that's losing less money this year than it lost last year is growing. And that may actually be true. I'm not going to argue with that. All I'm telling you is earnings growth is your first criteria. And you want to see like 30% earnings growth. Doesn't matter if the company's losing money. All that matters is that it's losing less money or it's making more money, and that number is significant because that drives excitement. The next thing you want to have is a 300% spike in daily trading volume. When you see a 300% spike in daily trading volume and earnings growth, that's exciting. You also want to have a rising on-balance volume line, a recent new high on the on-balance volume line, and that also applies to the price volume trend if that's what your software uses. You want the chart to be smiling at you. If you see smiling price activity and smiling volume activity, that chart is friendly. You don't want to see any new low prices for about 60 days. I'm going to show you what that looks like on a chart, but in your mind, picture down, 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 down. Those are all successive lows. And then sideways, 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 up, sideways, 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 up, 60 days, no new low. When you see that, that's a good indication that the markdown phase has ended. When you see that in conjunction with everything else, that's an indication you're in accumulation. Now, the other thing that I want you to be able to see before you place a trade is a future entry point that is clearly visible. Now, what are entry points? Well, you're looking at a chart, it's moving sideways. An entry point is the area right above where it's moving sideways. That's going to be the top of your 21-day channel. If you're looking at your chart and you're like, if this stock breaks out right there, I'm going to buy it, that is a clearly visible entry point. It's going to be clear. You're not going to have to guess. If you're looking at a chart, and we're going to look at a lot of charts before this is over with, and it's moving sideways, and then there's a shakeout, and then it pops up, and then it bases, right above that base is a clearly visible entry point. It's going to be obvious. When you see those things, that's your trading criteria. Earnings growth, 300% spike in daily trading volume, rising on-balance volume, recent new high in on-balance volume. The chart is smiling, no new low for 60 days, clearly visible future entry point. Let's talk about placing the trade. We're going to trade stocks as they move up in price on the long side. And on the short side, we're going to sell stocks as they fall in price. So in order to accomplish that, we place a buy order above the current price activity. And that forces price to have to go up through our order before we get in. Why? Because a stock that's moving sideways is boring, and buying a stock that's moving sideways is assuming risk, and we want to assume as little risk as possible. Therefore, we keep our money in the opportunity box, which is cash, waiting for a breakout of excitement to go into the risk box for a period of time while the stock moves up. So, the stock moves sideways, your order is here, it moves up, your order is triggered. Now you own a stock where there's excitement, there's rising price, and if you've done everything else right, you're going to place a stop loss below just in case it's a sucker's rally so you don't get cleared out, and then you're going to let the market do the rest of the work for you. How much money should you allocate to each trade? So that's a challenge. And the challenge is because it really depends on your account size. In my account size, I don't like to risk more than 2% of my account value. So that means that the vast majority of trades I enter into are gonna be less than $2,000. Sometimes it's more, sometimes it's less. It depends on how much margin I have available at the time. Is that the right criteria for you? Probably, unless you're just beginning and you only have maybe $1,000. If you only have $1,000, it's not going to be very practical of you to risk 2% of that $1,000 to place a trade. It could still be done. Robinhood allows you to trade commission-free. It'll give you some practice, but if you have $1 and you get a 300% return, you've made $3. I don't know that that's worth the effort. But if you only have $1,000 and you're just starting out and you have a job and you can afford to put some risk capital in, then what I want you to do is pick a number that's not going to make you cry if you lose the money, because even with everything in your favor, you're still going to get stopped out. It's still going to happen. It seems to me that the minimum amount of money that you can get excited about in a trade, depending on the price of the stock that you trade, is going to be about $200 or $300. With $200 or $300 as the maximum risk in your trade, if it goes against you, you get stopped out, you lose the $300. It might take, depending on your income level, another month or two to get some risk capital back, but it doesn't destroy you. If you have a $100,000 account, trading $200 or $300 at a time probably is not going to generate enough excitement to keep you interested. Then you're going to move to the 2% rule. As your account value goes up, if you stick to the 2% rule, with successful trading, the amount of money you're going to risk with each subsequent trade is going to go up, because you're always going to risk 2% of your capital. If you're going through a period where you're making some mistakes or the market is not in your favor and you're losing money, well, guess what? The amount of risk that you're going to take on each subsequent trade is also going to go down, because 2% of a $100,000 account is $2,000, but 2% of a $50,000 account is $1,000. So you will automatically adjust the amount of your bets based on the value of your account. When you have a smaller account, let's say under $10,000, you probably want to stick to a fixed figure, whatever your car payment is, or half of your car payment. You know, in this case, $300, $600. I don't know what your car payment is, but usually your car payment is a reasonable approximation of how much money you can flush down the toilet every month and not cry. Risk per share equals the entry price of the stock minus the lowest low price for the last 21 days. That's why we put that channel on the chart. So you're going to look at your chart, you're going to find where the stock is currently trading at, or where you think your entry price is. Then you're going to find the lowest low for the last 21 days, and you're going to subtract it. Whatever that number is, that's how much money you're going to risk per share. Then you take that amount and you divide it to the dollar amount that you're going to be willing to lose, and that tells you how many shares to buy. It's no longer the case that you have to buy 100 shares at a time or 1,000 shares at a time. Those days have been long gone. You can buy 1 share of stock today and they don't charge you any more commission. I'm not recommending that brokerage, by the way. I have an account there, but I will show you where I do most of my trading. That's just an example. Okay, so we're going to take our risk amount, 2% of our account value. We're going to divide that by our risk per share. That's going to tell us how many shares we're going to buy. So let's just say it's 44 shares. Okay, then you place your order, buy 44 shares at such and such stop price. And when the market goes up through that price, your broker buys you the 44 shares and you're in small accounts. Trade an amount that you're willing to lose without getting discouraged, because not all trades are profitable. Place a stop order at the price level where you believe the markup phase has begun, and then the price will put you in the market. Trail your sell stop loss order behind the rising price, and we're going to use that channel that we put on the chart as a guideline to know where to place that order. Remember, if a stock is going to go up, it's going to go up several times a month, and it's not going to make any new lows. That's just the way it is. In order for a stock that's worth $1 to get worth $10, it first has to be worth $2, and then it has to be worth $3, and then it has to be worth $4, and then it has to be worth $5. And if at any point on that climb it turns around and goes back to 1, there's something wrong. You don't want to be in anyway. That's the whole point of the trailing stop loss. But you want to give the market room to breathe, which is why we use the channel that gives the market room to fluctuate so you don't get stopped out unnecessarily. Generally, if a stock makes a new monthly, it's going lower. That's it. That's the point. That's why we do it that way. Okay, trailing your stop loss. We're going to go over that again because this is the key to taking money out of your account and being profitable. You must devise a method for trailing your stop loss. I'm giving you a basic method that I have used. I still use it. It still works because it operates the way the market operates. Rising prices rise until distribution sets in. Then the market turns and goes lower, and when that happens, you get stopped out. It's not rocket science. A time-based stop loss using the channels is one of the better ways that has been used the whole time stocks have been in existence to determine when is a good time to sell. Time-based, 21 days. That means it's made a new low, the lowest low in the last 21 days. Typically, if a stock does that, unless it's a shakeout, it's going to go lower. A 13-day low gives the stock a 2-week period, and if it makes a new low for 2¼ weeks, you sell it. That is a good time period to use in a relatively quickly rising market. If your time horizon is even shorter, you can use an 8-day low. The bottom line is, if a stock is going to go up, it's going to go up. And if it ain't going to go up, it's going to go down or it's going to go sideways. And if it goes down, you do not want to own it anyway. That's it. Now, depending on the broker that you use and the software that you're trading with, and there's a lot of different platforms, you can use what's called a volatility-based stop. And a volatility-based stop is very similar to a time-based stop, except It accounts for how violent the recent price moves have been. And the reason you want to do that is because as stocks begin to move, the public excitement generates this volatility. And you don't want to get taken out of a stock before the stock really is going to go down. So if you have a volatility-based stop indicator available in your charting program, that is a good one to use. And so you set it for a 13-day period or a 21-day period or an 8-day period, and it'll plot little dots on your screen, and then you can just drag your stop loss order up or however your particular broker software works. Again, I'm going to show you in my actual account how I do it with the software that I use. And if you have that software, you can do it exactly the same way. But if you're using TradeStation or you're using E-Trade or you're using Thinkorswim, whatever system they have is the system you're going to work with because that's the system you're comfortable with. And the bottom line here is that any way you do it is designed to keep you in the market while the price rises and to get you out when the market turns. So it doesn't really matter what you use. Some ways are more convenient, some ways are a little bit more profitable. The bottom line is you have to use something. There's another indicator called a parabolic SAR, which is kind of a combination between a time-based and a volatility-based stop loss. It tends to get you stopped out quicker. That can be good, that can be bad. The reason it's bad is because when a stock makes an accumulation period that lasts for 6 months to a year, that almost always results in a new major markup phase that might last for years. And so you don't want to get stopped out too soon and miss the whole move. If the only choice you have for a more advanced stop loss is the parabolic SAR, I would suggest you not use it and just go with the basic time-based stop loss. Even a slow-moving stock that goes up a few percentage points a month will give you returns that will make your investment worth it. I don't know if this is a dead horse yet, but I'm going to beat it again. Because you cannot make money in the stock market by losing money. You have to close losing trades quickly. You have to close losing trades quickly. When you place an order, you will always place a stop loss when that order is filled. Now, where you're going to place your stop loss is more art than science, but once you place it, it stays. We do not lower stop losses unless we're short and then we're lowering it behind the market. Stop losses move one direction. That is behind price movement. That's it. We don't cancel them. We don't say, I think there's going to be a shakeout, so I'm going to stay in. We close losing trades quickly. The second part of being profitable in the stock market over the long term and trading as a business is when you have a winner, you let it win. The trend is your friend and you stay with the trend until the trend ends. When the trend ends, you get out and you don't look back. We are not married to any of these stocks. We're only here to date them. If you trail your stop loss appropriately, the market will tell you when the trend has turned. We look for the accumulation phase. We buy the excited breakout. We ride the markup phase. And we exit when distribution begins and the market tells us when to do it. That's the whole point of the trailing stop loss. Cut your losses. Let your winners run. Once more, because this is the fundamental essence of what I am trying to teach you. This is what you paid for. I'm going to repeat it again. Sell your losers. Let your winners ride. Now, we mentioned earlier Jesse Livermore, and there's a great passage in Jesse Livermore's book, which is available, by the way, and you probably should buy it, although I didn't recommend it. He talks about a time where he was trading both wheat and cotton simultaneously. The wheat showed me a profit, and yet I sold it. The cotton showed me a loss, and yet I kept it. Now that's Jesse Livermore admitting about a mistake that he made that cost him millions. Now, if the most famous stock speculator that ever lived tells you, sell your losers immediately and let your winners ride, and when I didn't do it, I lost millions, take the advice. I can't emphasize this enough. If you want to take money home from Wall Street, you must religiously cut your losses and let your winners ride. Let the market determine when you get out by moving your stop loss up, and when your stop loss is hit, you're out. Think about this in another way. What we do here is not very difficult. I got to be honest with you. I have a lot of positions at any one time. I think right now I have more than 80 stock positions. Now, that sounds like a lot. This guy thinks he's running a mutual fund. Guess what? It's not hard work. I can go through all 80 of my positions in less than about 20 minutes. Why is it so easy for me? Well, I'm going to tell you why. Because I let the market make the decisions for me. What I look for are those keys that I told you before. I'm looking for rising on balance volume. I'm looking for a period of accumulation. I'm looking for a spike in volume. I'm looking for a smiling chart. I'm looking for a base. When I see those things, I just place an order. That's it. That's all the thought that goes into it. I'm going to buy $1,000 worth of that stock when it moves up. And then if the stock moves up, I'm in. And then, using the software that I have, I place a trailing stop loss behind my position. And only two things can happen at that point. Only two. And they both happen whether I pay attention to it or not. Doesn't matter. The two things are, the trade is profitable and the price goes up. The stop loss moves up behind it. Wonderful. Or the trade goes against me. Price falls. I get stopped out. I lose $1,000. That's it. That's what happens. And you don't have to do anything. Once you have it set up, your broker more or less does the work for you depending on the technology that you have. Now, if your technology does not allow you to set automatic trailing stop losses based on the monthly low, it's not the end of the world. Then what happens is once or twice a week or every morning if you want to, you're going to get in, you're going to look at your positions, and if the 21-day low has moved up, you're just going to move your order up. Okay, so it's going to take you a little bit longer, but not much. Let's face it, you're probably not going to have 80 positions in your account like I do. But even if you did, I would recommend you switch to the software that I use or find a suitable software that is more robust and can handle that for you, because it's all done by the computers today anyway. Once you establish your trading plan, let the market do the work. Place your buy order. When it's filled, place your stop loss order, then leave it alone. Like Ronco says, we set it and we forget it. Check your positions at least weekly. Move your stop losses up as appropriate. Never, ever lower a stop loss unless you're short. What's interesting about the system of stock selection that I have taught you in this course is because we only trade stocks with massive amounts of public interest, every once in a while, you're going to get into a trade that goes up 100 or 200% within a matter of days. The problem with that is sometimes those stocks keep going up, and sometimes the third day they collapse and you still lose money. We always want to stick with our winners as long as we can. We want the market to tell us when to sell. But when Mr. Wall Street hands you 2 to 3 times your money in 48 hours, you kind of have to say, thank you very much, and take some off the table. And let's talk about how to do that. So occasionally you're going to have the happy prospect, stocks moved up 100%, maybe in a couple days. Sometimes this happens in hours. If your trading platform allows you to place volatility-based trailing stops, then you just place one, and that stop loss gets adjusted based on volatility. So chances are, if the stock starts to come back down, your trade's going to be closed out anyway, and you're done. If your platform doesn't allow you to do that, or if you don't want to do that, maybe you prefer to use the time-based stop. And I can tell you the time-based stop has a tendency to work better with major trending stocks. So you may buy a stock based on all the criteria that we set, and then move your stop loss up once a month, and you might find that you caught a major trend and you're in that stock for 3 years. While you're in that stock for 3 years and the price is going up, you're not paying any taxes on that money. The price is consistently going up. There's a chance you're getting paid dividends, so there's no reason to jump out. Stay with your winning trades. But if your trading platform doesn't have the capability to have a volatility-based stop, and you get into one of these positions where you get 100% or 200% return in one day, sell half of your position. That's called the free trade. And I love free trades. In fact, one of the reasons I have so many stocks in my account is because I have a lot of free trades. Once I have a free trade, I generally stick with it as long as possible. A free trade is one you might want to put the 21-day graduated stop loss on, because a free trade is no risk. It's free. You already got your capital out. So the example, you buy $1,000 worth of stock. That stock goes up 100%. Doesn't matter what the price is. You buy a $1 stock, it goes to $2. You buy a $10 stock, it goes to $20. You buy a $100 stock, it goes to $200. It's based on the percentages, and it doesn't matter the value, or let me rephrase that. It doesn't matter the price of the stock because it's a percentage. When your position has doubled, sell half. Get your original investment back, put it in the opportunity box, leave your profit there in the risk box. Now you've broke even and you have a built-in profit. So how do you do the free trade? Well, you set your stop loss, and then you create another order to sell half of your position when the price of the stock has doubled. And you can do that all at the same time. You will have to talk to your stock software's technical people to learn how to set that up in your particular trading platform. But practically every broker's software will allow you to do that. So you have $1 stock, you buy it, you're filled at $1. You then go in and place an order at $2 to sell half your position. Price goes up to $2, half your position sells. Now you trail your stop loss up. That's the free trade. I don't do it on every trade, but you can if you want. All right, let's talk about money management. Money management is very important. Money management is essentially what you're doing, but it doesn't mean what you think it means. There's something in the trading business and the gambling business known as risk of ruin. And the risk of ruin is how many losing trades your account can handle before you're busted. Now, if you have a $50,000 trading account and you put all $50,000 of it in one trade and you risk it all in one shot, your risk of ruin is exactly the same as your percentage of winning and losing trades. So, as you start trading, keep track of how many trades are profitable and how many trades are losers, and whatever that ratio is your win-lose ratio. If your win-lose ratio is consistent, and you are very disciplined as to how you trade, then you can establish a graph of how successful you're going to be over the long run, assuming there aren't any major changes. If your win-lose ratio is 50-50, you win half the time, you lose half the time, but your winners, you make 3 times your money, and your losers, you only lose a small bit, over the long run, you're probably going to be profitable. Your personal risk of ruin is a calculation that you do based on your win ratios and how much money you have in your account and how often you trade. Guess what? Let's keep it simple. This system that I'm teaching you is all about simplicity because simple things work. So it turns out that some famous mathematician whose name I can't remember did all of these calculations about gambling and trading and Forex and stocks. And what he found out was, unless you are extremely unlucky or the worst trader in the world, if you never risk more than 2% of your account balance on any single trade, it is next to impossible to destroy your account. Think about that. If you have a $100,000 account and you trade 2% of your trade every time, that gives you 50 trades at $2,000 a whack before you're wiped out. And that assumes you lose money on all 50 trades. Now, I'm going to tell you a little secret about the stock market. If you lose money on 50 trades in a row, you probably deserve to be wiped out. If you adjust the amount of risk every day on your trades to 2% of your account when you hit a losing streak, and that does happen, let's face it. Right now we're in a bull market, so it's pretty hard to lose 50 trades in a row using the system I'm teaching you. If you're doing something else, well, okay, that's something else. With the system that I'm teaching you, it's not that bad. It's actually pretty good. It's fabulous. I use it all the time. The system that we use, we buy stocks that are rising. We only stay in them as they rise. So the first part of it, it's 50% in your favor anyway. You already have a rising stock. The second part of the system is we're looking for stocks with public excitement. When there's public excitement, the public buys. So there's another thing in your favor. We're looking for stocks that are no longer making lows. We don't buy the bottom. We buy the rise. So we put as many things in your favor as possible. So it's highly unlikely that you're going to lose 50 trades in a row following this system. But if you did, as long as every time you placed a new trade, you used 2% of your account balance, the amount of your trades is going to go down as your balance goes down. If you have 100,000, 2% is $2,000. If you have $50,000, 2% is $1,000. So the size of your trades will scale down while you're not doing it right. If you lose more than 4 or 5 times in a row, you're definitely doing something wrong. Stop. Something's wrong. You're in a bear market. Your charts are upside down. You're definitely doing something wrong. While you're making money and your account balance is going up, the size of your trades is going to go up with them. If you have 100,000, 2% is $2,000. If you have 200,000, 2% is $4,000. So the scale of your trading moves along with the success or failure of your trading. That's why the 2% makes sense. Adjust the risk with every trade. A series of losses will lower the amount of risk you take. A series of winners will yield subsequent larger bets. That's how we manage the capital, unless you have a small account. If you only have a few $1,000s, then you have to go back more or less to the car payment analogy. Take your car payment, whatever that is, that's how much you're going to risk, because you're already throwing that money away every month anyway. You may as well have an opportunity to profit from it. It's all based on percentages anyway. So if you have $100 to trade and you trade $100 and you make 30% on it, you now have $130. That's 30% return on your money. That's fabulous. If you have $1,000 to trade and you make a 30% gain, you now have $1,300. So at whatever level you're at, the percentages are going to work if you do everything right. If you have a small account, it's going to take a while to build into something significant. However, as your account grows, the size of your trades can also grow. Now, I would not stop using the car payment analogy for the size of your trades until 2% of your balance is greater than that. Once 2% of your balance is greater than that, use the 2% rule. Regardless of your initial account size, if you leave the money in and you trade consistently, you have the potential to grow an enormous balance. But you have to do it consistently. Now let's talk about the actual business of trading, because the way I trade, it's a business. We are not doing investments here. We are buying low-priced items. We are selling those items for more money. It's a retail kind of business, but we're doing it with stocks, and we don't have to deal with customers because our customer's on the other side of the computer. Consider your account balance as your inventory and your building materials. Your charting software and data and broker are your tools. That's your hammer, your nails. The stocks that you trade are your clients. The stock's actually your customer. Like any service business, you have to pick your clients well, because if you pick bad customers, they're going to drive you crazy and you won't be profitable. Make sure at least once a year or once a quarter, depending on how big your account is, that you take some profit out of your account home. If you have a $1,000 account and you're trying to build something significant, if you double that account, it probably doesn't make sense to take any money home. You need to build up your account value. But At the end of the year, regardless of how much money you have in your account, if you have made some sort of progress and some sort of profit, take some money home and use it to celebrate. Consider the amount of trading opportunities that are available in any given year, okay? And it's not unlimited. There are a lot, but it's not unlimited. It's probably around 500, okay, of stocks in a bull market that fit this criteria. You're going to have a couple of them a day while the bull market's going on. During a bear market, unless you short, which I don't really do, you're not going to have hardly any opportunities because nobody wants to buy stocks in a bear market. That's what a bear market is. So all of the stocks go to sleep. But that's good because while the stocks are sleeping, you're not in them. All of your money should already be in the opportunity box waiting for the next bull run. And when you catch a bull run at the bottom, that's the happiest time of your life. So when the bear market happens, if you have all your stop losses in place, subsequently, all of your positions are going to get closed out. That's going to push all of your money into the opportunity box. And now you just wait. And when the market bottoms, you're going to have accumulation followed by markup, and you're going to be on the sidelines ready to take care of it. I can't sleep. I'm worried about my stocks. If you ever find yourself in a position where you can't sleep because of your trading activities, then you need to sell down to the sleeping point. If you buy a stock and you are so terrified because the position is $10,000 or it's $50,000 or whatever it is, and you cannot think, that position is too large for you. And that number's different for everyone. Sometimes you worry constantly about 500 bucks. I know other people who will throw $50,000 into a trade and not give it a second thought. But it's different for different people, and because this is your business, you have to manage your business so you enjoy it. Sell down to the sleeping point. If you ever find yourself in a position where the amount of money in your account is so much that you're thinking about it all the time, pull some money out. Do something else with it. Only trade with money that you're comfortable with. If you're not relaxed, if you're not comfortable, it's going to be very hard for you to do the kinds of things that are necessary to do in order to profit. You have to be relaxed. You have to trade with money you're not afraid to lose. If you're worried about the money, you're gonna make mistakes. If you're anxious about the money, you're gonna make mistakes. Do not trade with the rent money. Do not trade with the new baby's pair of shoes money. We speculate with money we can afford to lose because not all trades are winners. Now, one final point before the end of this section, and that point is every brokerage firm out there will allow you to trade what they call on paper. And paper trading accounts are there so you can get comfortable with the software and the style of trading that you're doing. And I highly recommend, before you put your money in the market as a trader, that you trade in your paper trading account until you are relaxed and comfortable and understand what you're doing. Because I do run a paper trading account in the background because I use that for testing new ideas. I hope you've enjoyed this course. I hope you got a lot out of it. Don't forget to do work. Buy those 3 books. Read those 3 books. Go through this material more than once. We covered a lot. I talk really fast. There's a lot to learn. Paper trade. And I wish you luck. I hope all of this works as well for you as it's worked for me. Thank you very much.